Today we're going to be talking about what is a stock, what is a stock market, all in preparation to understand the stock market crash of 1929. Sorry. So let's say that you and your friends want to start a business. Maybe you guys could make a movie, like a zombie movie. But you have a script, you have costumes, you have everything, but you don't have an expensive video recorder that could really make it good. So what you need is money, and you need investors. But what are the investors going to get in return? What you're going to have to give them is something of value in return for their investment, the money they give you to buy the camera. And one thing that you could give them is stock, which is a part ownership in your company. It's not exactly the kind of ownership where you can have a say in how things are going most of the time, but what it does is it gives you part of the profits. And what they call those profits are, when they're given to stockholders, is dividends. So let me just reiterate. You have a business idea. You don't have as much money as you need. You ask for investors to give you the money. In exchange, you give them part ownership in your company, in the sense that they're going to get a percent of the profits, which we call dividends. That seems reasonable, right? But it doesn't stay as reasonable as that. But before we go to the next level, I just want to say, if I were an investor, I would want to know a lot about your movie, your zombie movie, before I decided whether it was a good gamble to invest in this company. But no matter how much I understand, it's still a gamble. And buying stock, we can still call it speculation. Today, on the stock market, a lot of things are regulated, including how truthful you have to be when you're selling stock to investors. You know, when a company is selling stock to investors, you know, you can't say things that aren't true in the process of selling stock. But anyway, so what happens after you've given it stock? Stock turns out to have another life after the person's originally bought it, and it goes to Wall Street. Wall Street is in Manhattan, so northern Manhattan, and the New York Stock Exchange is where most of, especially the 1920s, which is the period we're going to be studying, Wall Street is mostly where people traded, bought and sold stocks. So the person who originally bought a piece of your company in the form of stock doesn't have to keep that. Maybe he or she needs money and she can sell it. So she sells it on Wall Street, and the person who helps her is a broker. Now on Wall Street, there's so many stocks, and the value of the stocks go up and down each day. A lot of things affect what the value of the stock is. One thing, of course, is all about your company, right? Maybe your script writer is known to produce good movies, and everybody knows that. But other things affect stock too, one thing that affected the prices of stock in the period we're talking about, in the 1920s, is buying on credit. In the 1920s, you could buy stock where you only put in, say, between 10 and 25% of the price, and your broker would lend you the rest. So when money comes so easily, you spend it a little bit more easily. The other thing that affects stocks, the trading of stocks, is confidence. It's not just confidence in your company, which is a big thing, but it's confidence in our country, it's confidence in our economy, it's confidence in our stock market, and whether it's not being manipulated. So what I mean by manipulated is people can do all kinds of dishonest things to make a price of a stock go up or down, when it shouldn't. If you just looked at the company, the price shouldn't be going anywhere. It should be staying exactly where it is, but people can manipulate the cost of a stock by, for example, buying a lot of it and making everybody else think, oh, well, they're buying a lot of it, I better buy a lot of it too. In the 1920s, before 1929, when there was a crash, the price of stocks on the New York Stock Exchange had been going up and up and up and up, but it kind of took on its own life. Because it had been going up, people felt like they could invest in it, and because they invested in it, it went up, right? So it's kind of like a cycle, going round and round. Even regular people in the 1920s, mailmen, bakers, owned stock. They got used to investing in things because of something called Liberty bonds. Liberty bonds, which the government sold during World War I. And they got investment money out of that, and so it became the kind of thing that everyday people owned some kind of investment that was a piece of paper. So as I said, it was going up in the 20s. Because it was going up, people thought it was a good investment, so they poured more money into buying stocks. The real value of the stocks and the value the stock was being traded at had nothing to do with each other anymore. And let's see if I can find room on here. The last thing that I want to talk about is a bubble. B-U-B-B-L-E. A bubble is when things are inflated and they get big and big and big, and then they burst, right? In the 1920s, the stock market, there was a bubble where the prices for these pieces of paper, part ownership in companies, was much higher than the reality. And when there's a bubble, it's only a matter of time before it bursts. Okay, I hope that gives you a beginning of an understanding of how stocks, what stock is, how the stock market works, how the stock market can get overinflated, what a bubble is, how people trade stocks, just the general mechanics of the stock market. And then we can talk more, now that we understand all this, we can talk more about the stock market crash of 1929.